He says, if you deem stock prices to be overvalued or in a bubble, do you think it's best to keep your money in cash while waiting for prices to come down to a fair price? Or would it be a better idea to invest this money in some way while waiting until stock prices are fair again and then sell the investment to buy the stock?
Well, Charlie and I have had that discussion on a lot of things. We bought some stocks we really don't know that much about, but I'm not really comfortable doing that.
You're used to shooting fish in a barrel, but that's gotten harder.
We've got probably 10 to 15% of our total assets in cash beyond what I would like to have, just as a way of protecting the owners and the people that are our partners from ever having us ever get in a pickle. You know, we really run Berkshire to make sure that we don't want to lose other people's money who stick with us for years. We can't help what somebody does that buys it today and sells it tomorrow. But we've got a real gene that pushes us in that direction. But we've got more than we've got probably 70 or 80 billion, something like that maybe, that we'd love to put to work. But that's 10% of our assets roughly, and we probably won't get a chance to do it under these conditions. But conditions change very, very, very rapidly sometimes in markets, and we do have people that would like to join us, but the market option they have is too great for them. And if they're publicly traded, I mean, they basically can't. They would have great difficulty, well, then making a deal with us because somebody else would come along with using other people's money. It's, you know, we may be unhappy about the 70 billion, but we're very happy about the other 700 billion. So it's not like we should complain.
So there is a clear strategy that Buffett employs. The main game of Warren Buffett is to find stocks that are undervalued. Ever since he picked up Benjamin Graham's book, The Intelligent Investor, when he was just 19 years old, he's invested that way. Find stocks that are cheaper than their intrinsic value. Now let's be honest, in today's market, there's hardly any of those deals floating about. The S&P 500 is sitting at 46. That's 3 times higher than the average of 15 across history. And this is the second highest that they've been over the past 140 years. So Buffett's strategy in these times is very unique. He's got a huge cash pile of $138 billion. He could buy any stock, pretty much any business that he wants, but he's purposely choosing to wait, just letting that cash pile build up into something that even Jerome Powell would be impressed with. And essentially he's waiting for a business to come along at an attractive price, preferably a big blue chip one so that he can deploy most of his cash. But right now these businesses don't seem to be showing up. They all seem to be going for sky high prices. Buffett doesn't pay any attention to these. He only focuses on the parts of the market that are worthwhile.
Yeah, just raise your hand and the monitor will supply the microphone.
Thank you. Howard Winston from Cincinnati, Ohio. One question. Are you concerned about the rising valuations on the NASDAQ market where companies trade at multiples of revenues instead of multiples of earnings?
The rising value of what did you say?
The NASDAQ market.
Oh.
Where they traded 10 times revenues or more, 30 times revenues instead of 10 times earnings.
Yeah. Well, we don't pay much attention to that because throughout the careers Charlie and I have had in investing, there have always been hundreds of cases or thousands of cases of things that are ridiculously priced and phony stock promotions and the gullible being led into to believe in things that just can't come true. So that's always gone on and always will go on, and it doesn't make any difference to us. I mean, we are not trying to predict markets. We never will try and predict markets. We're trying to find wonderful businesses, and the fact that a part of the market is kind of screwy, that's unimportant to us. We tried a few times shorting some of those things in our innocence of youth, and it's very tough to make money shorting even the obvious frauds, and there are some obvious frauds. It really is. It's not so tough to find the obvious frauds, and it's not tough to be right over 10 years. But it's very tough to make money being short them. Although we tried a few times way back. We don't look at indicia from stocks in general, or from PEs or price sales ratios, or what other things are doing. We really just focus on businesses. We don't care if there's a stock market. I mean, would we want to own Coca-Cola? The 8% we own of Coca-Cola, the 11% of Gillette. If they said we're just going to delist the stock and we're never going, we'll open it again in 20 years. It's fine with us, And if it goes down on the news, we'll buy more of it. So we care about what the business does.